how one of the world's most successful investors thinks about markets. What if I told you that George Soros, the man who broke the Bank of England and made billions in currency speculation, believes that markets are fundamentally irrational and driven by human psychology rather than mathematical models? Today, we're diving deep into The Alchemy of Finance, a book that challenges everything traditional economists believe about how financial markets actually work. This isn't your typical investment guide filled with technical analysis charts and get-rich-quick schemes. Instead, Soros presents a revolutionary framework called reflexivity theory that explains why markets crash, how bubbles form, and why conventional economic wisdom often fails spectacularly. Whether you're a seasoned trader, business owner, or someone simply curious about how the financial world really operates, this book will fundamentally change how you think about market and human behavior. What makes this summary particularly valuable is that we're breaking down Soros's complex philosophical and practical insights into digestible sections that you can immediately apply to your own understanding of finance and decision making. We'll explore his real-world examples, dissect his theoretical framework, and extract the key lessons that have made him one of history's most successful speculators. The Alchemy of Finance represents George Soros's attempt to bridge the gap between abstract economic theory and the messy reality of actual market behaviour. Published in 1987, this groundbreaking work introduces readers to Soros's revolutionary concept of reflexivity, which fundamentally challenges the efficient market hypothesis that dominated economic thinking for decades. Unlike traditional finance books that focus on mathematical models and statistical analysis, Soros approaches markets from a philosophical perspective rooted in his background studying under Karl Popper at the London School of Economics. The book emerges from Soros's practical experience as a hedge fund manager, combined with his intellectual curiosity about the nature of knowledge and human understanding. The title itself carries deep meaning, comparing financial speculation to medieval alchemy. Just as alchemists sought to transform base metals into gold through mysterious processes, Soros suggests that successful investing involves transforming incomplete knowledge and fallible perceptions into profitable outcomes. This metaphor highlights the inherently uncertain and subjective nature of financial markets. What sets this book apart is Soros's willingness to expose his own thought processes and decision-making frameworks. Rather than presenting himself as an infallible guru, he openly discusses his mistakes, uncertainties, and the evolution of his thinking. This transparency provides readers with unprecedented insight into the mind of one of history's most successful speculators. The book combines theoretical exposition with practical application, featuring detailed case studies from Soros's own trading experiences. These real-world examples demonstrate how reflexivity theory operates in actual market conditions, making abstract concepts tangible and actionable for readers. The central premise of The Alchemy of Finance revolves around Soros's theory of reflexivity, which posits that market participants' perceptions actively shape the reality they're attempting to understand and predict. This creates a feedback loop where thinking influences events, which in turn influence thinking, leading to inherently unstable and unpredictable market dynamics. Soros argues that traditional economic theory fails because it assumes market participants have perfect knowledge and act rationally. In reality, he contends, all human knowledge is imperfect and all market participants operate with incomplete information and cognitive biases. This fundamental limitation creates opportunities for those who understand and exploit the reflexive nature of markets. The book traces Soros's intellectual development from his early philosophical studies to his practical application of these ideas in financial speculation. He explains how his background in philosophy, particularly his study of fallibilism under Karl Popper, shaped his approach to understanding markets and making investment decisions. Throughout the narrative, Soros emphasizes that successful speculation requires recognizing the inherent uncertainty and instability of markets, rather than seeking false certainty through mathematical models. He advocates for a dynamic approach that remains flexible and responsive to changing conditions rather than rigid adherence to predetermined strategies. The book culminates in Soros's detailed account of his most famous trade, breaking the Bank of England in 1992, demonstrating how reflexivity theory can be applied to identify and capitalize on major market dislocations. This practical application serves as the ultimate validation of his theoretical framework. The first major concept Soros introduces is the theory of reflexivity itself, which fundamentally rejects the idea that markets efficiently process information to reach equilibrium prices. Instead, he argues that market prices are shaped by the collective biases and misconceptions of participants, creating self-reinforcing cycles that drive prices away from any theoretical fair value. This insight explains why markets experience boom and bust cycles that seem irrational from a traditional economic perspective. Soros dedicates significant attention to explaining the boom-bust sequence, a recurring pattern he observes across different markets and time periods. This sequence typically begins with a prevailing trend that attracts participants based on some underlying bias or misconception. As more people embrace this bias, their actions reinforce the trend, creating a self-fulfilling prophecy that drives prices to unsustainable levels. Eventually, reality intrudes. The bias is exposed as flawed, and prices collapse as participants rush for the exits. The concept of far from equilibrium conditions represents another crucial insight from the book. Soros argues that markets spend most of their time in unstable states rather than the equilibrium conditions assumed by traditional economic models. During these periods, small changes can produce disproportionately large effects, making prediction extremely difficult and creating opportunities for those who understand these dynamics. Soros introduces the notion of fertile fallacies, which are misconceptions that, while technically incorrect, become temporarily self-fulfilling through market dynamics. These fallacies can persist for extended periods, creating profitable opportunities for those who recognize their temporary validity while remaining aware of their ultimate unsustainability. Understanding this concept helps explain how seemingly irrational market trends can continue far longer than logical analysis would suggest. The book explores the role of bias in shaping market outcomes, distinguishing between passive and active biases. Passive biases involve misconceptions about existing conditions, while active biases influence the conditions themselves through participants' actions. Soros argues that understanding and identifying these biases is crucial for successful speculation, as they create the reflexive feedback loops that drive market dynamics. Soros emphasizes the importance of testing hypotheses through market positions rather than purely theoretical analysis. He advocates for a practical approach where investors formulate theories about market conditions, express these theories through actual trades, and then modify their understanding based on market feedback. This process of continuous hypothesis testing and refinement represents a more scientific approach to investing than relying on static models. The concept of fallibilism permeates Soros's approach, acknowledging that all human knowledge is imperfect and subject to error. Rather than seeking certainty, successful speculators must learn to operate effectively within conditions of uncertainty, making decisions with incomplete information while remaining open to revising their understanding as new evidence emerges. Finally, Soros discusses the critical importance of timing in implementing reflexivity-based strategies. Understanding that a trend is unsustainable is insufficient. Successful speculation requires identifying when that trend will reverse. This timing element adds another layer of complexity to applying reflexivity theory in practice, requiring both theoretical understanding and practical market sense. The first key takeaway emphasizes the fundamental importance of recognizing your own fallibility and limitations. Soros repeatedly stresses that successful investing begins with acknowledging that your understanding of markets and economic conditions is inherently imperfect and subject to error. This humility creates the mental flexibility necessary to adapt when market conditions change or when your initial analysis proves incorrect. Rather than clinging to failing positions out of ego or stubbornness, acknowledging fallibility allows you to cut losses quickly and redirect capital toward more promising opportunities. Understanding market psychology proves far more valuable than mastering complex mathematical models or technical analysis systems. Soros demonstrates that markets are driven primarily by human emotions, biases, and misconceptions rather than rational calculation. Successful investors must develop the ability to identify and understand these psychological factors, recognizing how fear, greed, overconfidence, and herd mentality influence price movements and create opportunities for those who can think independently. The concept of boom-bust cycles provides a framework for understanding recurring market patterns across different asset classes and time periods. By recognizing the typical progression from an initial trend to widespread acceptance to eventual collapse, investors can position themselves advantageously at different stages of these cycles. This understanding helps explain why markets regularly experience bubbles and crashes that seem obvious in hindsight but were difficult to predict in real time. Developing hypothesis-driven investing represents a more scientific approach to market speculation. Rather than relying on gut feelings or following popular trends, Soros advocates formulating specific testable theories about market conditions and expressing these theories through actual positions. This approach creates a feedback mechanism where market results provide evidence about the validity of your underlying assumptions, allowing for continuous learning and improvement. The importance of position sizing and risk management emerges as a crucial practical lesson throughout the book. Soros emphasizes that even correct analysis is worthless if you bet too little to matter, while betting too much on any single position can lead to catastrophic losses. Understanding how to size positions appropriately based on conviction levels and potential outcomes represents a critical skill that separates successful speculators from those who eventually blow up. Timing proves just as important as identifying correct trends or market dislocations. Soros demonstrates that being early can be just as costly as being wrong, particularly when using leverage or operating with limited capital. Successful implementation of reflexivity-based strategies requires developing an intuitive sense for when market conditions are ripe for major moves rather than simply identifying structural imbalances. The value of maintaining intellectual independence cannot be overstated in Soros's framework. Markets are inherently social phenomena where consensus thinking often becomes self-defeating as too many participants pursue the same strategies. Developing the ability to think independently, question popular assumptions, and maintain contrarian perspectives when evidence supports them represents a crucial competitive advantage. Understanding the reflexive relationship between perception and reality provides insight into how market trends develop and eventually reverse. Recognizing that participant perceptions actively shape the conditions they're trying to analyze helps explain why trends can persist longer than fundamental analysis would suggest, while also providing clues about when those trends might reverse. The importance of maintaining mental flexibility and avoiding ideological rigidity emerges as a consistent theme throughout Soros's approach. Market conditions change constantly, and strategies that work in one environment may prove counterproductive in another. Successful investors must remain adaptable, willing to abandon previously successful approaches when market dynamics shift. Finally, Soros emphasizes that speculation should be viewed as a form of intellectual challenge rather than merely a way to make money. This perspective encourages continuous learning, intellectual curiosity, and the development of increasingly sophisticated understanding of market dynamics, ultimately leading to better long-term results than purely profit-focused approaches. The Alchemy of Finance stands as one of the most intellectually challenging and practically valuable books ever written about financial markets. Soros succeeds in bridging the gap between academic economic theory and real-world market dynamics, providing readers with a framework that explains market behavior far better than traditional models. What makes this book particularly powerful is its combination of philosophical depth and practical application. Soros doesn't simply present abstract theories, he demonstrates how these concepts can be applied to generate extraordinary investment returns while acknowledging the inherent risks and uncertainties involved in market speculation. The reflexivity framework offers readers a new lens through which to view not just financial markets, but any situation involving human perception and decision-making. This broader applicability makes the book valuable beyond its immediate financial context, providing insights relevant to business strategy, political analysis, and personal decision-making. Perhaps most importantly, The Alchemy of Finance encourages readers to develop their own thinking rather than simply following established rules or conventional wisdom. Soros demonstrates that the most successful market participants are those who can think independently, question popular assumptions, and develop unique insights about market dynamics. For anyone serious about understanding financial markets, developing investment expertise, or simply curious about how human psychology drives economic outcomes, this book represents essential reading that will fundamentally change how you think about markets and decision-making in uncertain environments.